Well, it's good times in equity land. The Aussie dollar is the best performing currency in G10. Gold continues on its stealth climb towards 1850. And commodities are ripping at the moment. They're a trend follower's dream. We chase all these markets and assess the trade-off. Well, hi, my name's Chris Weston, Head of Research here at Pepperstone. I'm going to be joined, as always, in a second by my good friend Blake Morrow from Forex Analytics. And we're going to be unpacking, we're going to be navigating, and we're going to negotiate all the landmines, the thematics, the setups in this mad world of trade. Of course, if you like what you hear from Blake or my good self, just make sure you hit the like button. I'd really appreciate that. Subscribe to the channel if you can. And of course, it goes without saying, do your own research around any of the ideas that Blake and I focus on in this program. I'm going to bring Blake into the program because the first thing I want to do is I want to get Blake in shot, and I want Blake just to gently turn his head to the side, if you wouldn't mind, Blake, and just assess just the King Jong-un styling that's going on. Obviously, a sharp haircut ahead of the weekend. What's your call then, Blake? What's your call on the Superbowl for the weekend? Where are you going? I'm personally going Matthew Stafford to take this one home. I think LA gets this one and covers the line of 4 points as well. So what's your call there?
You know, that's a man, Matthew Stafford. Well, he was one of the highest paid NFL players at just a few years ago, and I'm not sure where that stat is now. But that guy, he is choked beyond belief going into all playoffs, and now that he's here, I think he's going to take it over the finish line. I think he's the man to get the job done. And it's not just him; it's Arnold, the defender. Oh, that guy's a beast. So yeah, I'm with you, man. I feel sorry for the Cincinnati fans. They're probably going to have another failed attempt.
Well, I think they cover the line 4 points. I think we get more than 48.5 points. That's my bet there as well. So we'll have to see. But let's go into the program and let's assess what's going on in terms of Topical Funder today. Blake, look, we're saying this program, we're recording the program before the US CPI number. The US CPI number, for me, could hold some big premises. For me, as we look ahead for the March FOMC meeting, there's probably three major factors that we're looking for. One is the CPI print in the session ahead, the non-farm payrolls number that comes out on the 4th of March, and obviously the wage data really important there. And then we get the February CPI print that comes out on the 10th of March, and that could mean the difference between a 25 basis point hike from the Fed or a 50 basis point hike. So this number is really, really important. Whether it comes out lower than expected, the market's looking for 7.3% on headline. If it comes out towards 7%, you could see the dollar sell off. Rates could go bid. We could see equities working quite well, led by tech. Obviously, if we get a topside number there, say 7.5%, then we could, you could see the dollar rally, dollar yen could rally, and big sort of assess the distribution of probabilities around the playbook, and that's where it is. But for me, the market is really looking at this CPI number as a big ticket item. It is a potential volatility event. What are you thinking at the moment? How important do you see this number in that debate of whether we get a 25 or a 50 basis point hike in that March meeting?
Well, I agree with you 100% wholeheartedly, and I think the market does too, Chris. If you look at the market, it has been range-bound, tight ranges this entire week. The price action's been poor, volumes have been down, and everybody is waiting for the most highly anticipated data of the week that comes out tomorrow morning for me, but later on today for you guys.
Yeah,
tonight.
Half 12 at night for us. So yeah, it's a late one.
It's going to be a night for you, but it's going to be an important piece of data, and we're all waiting. I mean, you look at the euro; we're range bound between 114, 114.50. The equity markets have gotten a nice boost, and that's going to be kind of interesting as well. But Chris, I'll tell you, the White House came out and they said, "Hey, expect a strong print tomorrow for us tomorrow. Yeah, expect a strong print." And so, the limited response from the dollar is a little surprising to me. And I watched the S&Ps, and the S&Ps continue to climb right to that shoulder level we talked about last week on the spiders. We're there today. Yeah. So it's, we're right up into a big pivot. going into this data. So tomorrow's really going to matter, Chris. It's going to matter.
And we're going to be talking all about commodities throughout the show. And I think one of the best hedges against inflation at the moment, I think the market is saying it's not gold necessarily, it's not crypto. If we want to hedge this, let's go and buy commodities. Let's talk about agricultural commodities. Let's go and buy industrial metals. Let's get into this space, because softs, agriculturals, they're flying at the moment. They're cooking pretty hard, and they're a trend follower's dream, as I talked about in the synopsis there. So I think CPI is a big one. We talk about the dollar, we'll talk about euro dollar in a second, but for me, the question you've got to ask yourself is, if we were to, let's say 7.3% is the median number, do we get a bigger reaction on the downside in the dollar if we get 7.1%, or do we get a bigger upside response if we get 7.5%? I actually think we get a bigger response if we get a strong number, but if we do get a weak number, say 7.1%, euro dollar's breaking out to the top side, and I think dollar's going to really come off quite sharply on the back of that.
Yeah, and I think, and I'm going to agree with you and take us right into the next topic with the stock market. And I mean, it depends what market you're talking about, but I'm just going to talk about the S&P right now. Yeah. We are up against a key resistance. I understand this. We talked about it last week. We're right up at that 4,600 level. And I'm quite frankly surprised we're actually here.
Everyone's surprised. That's the thing, is everyone's like, why is this here? And no one knows. And we're trying to put reasons behind it.
It's not so much that we're here. I'm just surprised that we're here and holding here. Right. It's, I expect us to get here and then back off a little bit ahead of the number, but no, ahead of the number, we're right up against 4,600. So if we do have a weaker than expected number, the risk is at this point that we might challenge all-time highs. So, and I'm starting to see, financial Twitter starting to talk about it. People are talking about, here comes the melt up. I mean, what do you think, Chris? Is it possible, even in the face of higher rates globally?
It hurts, doesn't it, to be long? It doesn't feel right. It doesn't feel right at all. But we've got earnings out of the way. The market's rallied in the face of the long end of the curve going to 2%, or we're getting close to 2%. We've priced in 5 rate hikes. They're talking about front loaded. But yet the market's just plodding on, and it's just, people have been covering short positions quite aggressively. We're now seeing trend following fund CTAs starting to actually drip feed length. It's not just been covering shorts, but actually buying. Volatility's come down now. We've got the VIX below 20%. Realized volatility should drop as well, and that should allow capital to come back in. But, there's no volume coming through. Have a look at S&P futures last night. 1.3 million SPUs traded. It's pathetic. So I think participation in the futures market has allowed it to go up. But you're right. If we get a weak CPI number and there's a genuine belief that we've seen peak inflation and we should start gravitating back down to 2-3%, and we've seen the highs in yield, this equity market could be higher than where I was. So I think if we get 7.1%, certainly if we get a 6 handle, that would be a big surprise. And tech's going to rip in that situation. Of course, if we do get 7.5%, we could see equities under a bit of pressure. But this is one of those things where no one's believed in this rally that we've had, and they will continue to not do so. If we see a break of these levels that you've been talking about, and it continues to melt up, given all the dynamics of higher rates and all these other factors, no one's going to believe it, and it's not going to feel right buying. But you just got to follow the tape there.
Yeah, and you just said it. Follow the tape. So reading price action tomorrow is going to be really important. So if we have a lower print than expected, stocks rally, how they close is going to be really important. Absolutely. So if they take out the highs, stop everybody out on their shorts, and everybody's like, yeah, here we go into new all-time highs, and then we reverse. That's your cue if you want to be short. But, Chris, I tell you, you're right. It doesn't feel right, but we're climbing that wall of worry. And I have to remind people, interest rates go up and down, and the stock market over the long term does go higher. So, that's something.
Well, I just think as well, small caps have been outperforming now. You're starting to see high beta stocks outperforming. All the market internals are telling me that there's this is looking quite good. So a weak number I think is going to be a pain trade there, and see this market going higher. And talking about markets here, let's have a look at the commodity trade, because it's been ripping. We talk about this hedge, but it's not so much necessarily about what's happening in crude. Crude had a little bit of a pullback into sort of 88.50, found some buyers. We're back above $90 now in WTI. But it's everything else that we're seeing. You know, there's a reason why commodity trading advisors or systematic trend funds, what they do is they get themselves a big pool of assets to be able to trade, and then their systems will say, yeah, this rule-based situation now, this is trending, this is a bullish trending market. And there's a reason why you tend to see things like Italian debt, BTPs coming on their radar and traded. There's a reason why a lot of the time you tend to see agricultural commodities, because they trend like absolute beautiful, like probably some of the best trending instruments you can. If you like to buy low and sell high, or like to buy high and sell higher, and look for things that are just moving, this is the space to go. So have a look at what's been going on at the moment in soy meal. It was my play of the day last week. It's working beautifully. Soybeans, absolutely killing it. Cattle, loving it right now. And then you can go into things like copper. Copper's just broken out there. You've just seen aluminium trading at the highest levels for a long time. And then we've obviously got gold, which has been having this stealth climb towards 1850. Commodities are absolutely ripping now. So if you're a trend follower out there, if you're not rules-based, if you're not systematic, and these would have come up onto your radar, go and take a look at cattle, go and have a look at beans, go and have a look at all these markets, because they are absolutely ripping. Coffee just looks beautiful at the moment. So, whether there's something, and it got to concern the Federal Reserve. Food makes up 14% of the CPI basket. It's at the highest levels, I think, for about 14 years. So, this is a space that's super red hot at the moment.
It is, and you were talking about copper and crude and gold. A lot of those have made their moves, and so copper is trading at levels that we hadn't seen since maybe October or November of last year. Yeah. But we're still in a triangle. I still look at it as a consolidation, but we're nearing. We still have some distance to go just to get to the resistance of that move. Gold nearing 1850. That's a really big triangle resistance. I think I brought it up. It's big, right? I mean, if it breaks, what do you do? I mean, you got to get long, right?
1850. Oh, it's just a little bit below that is the downtrend. So if that breaks, and then you've got the recent swing around 1853. If we get a weekly close above that, in my opinion, you start a new bull market in gold, and I think that's going to be absolutely, it's going to be well traded. It's going to be, heavily talked about. You might see the implied volatility in gold, which is pretty pathetic at the moment, start to rise. People are going to expect more impulsive moves. That's going to bring a lot more sort of day trade capital into it. But if it starts bull trending like that, then the CTAs, the trend following funds, will start adding length into futures, and that just perpetuates the move higher as well. So we talk about these agricultural commodities which are trending beautifully, but gold's got to be on the radar. And if you get a weekly close above 1853, I think that starts a new bull market in the precious metal complex there.
Well, Chris, what's going to perpetuate it even further? Let's talk about the dollar, because the dollar, which has been king dollar, and it was all year last year, and we come into 2022, people expecting the dollar to rip higher. Here we are, near the lows, and you've got euro knocking on the door of 115.
Yep.
And I mean, we talked about this last week, and you brought up a really good point about peak FOMC or just central bank hawkishness in general. And I think that was a good topic to talk about for last week. And we saw the ECB meet last week. Euro ripped higher.
Yep.
You've got the dollar really on its back heels here, or on its heels. And to be frank, I mean, we dropped below 95 on the dollar index. 94.50 is kind of like the line in the sand for me. We break through that level. Holy cow, the dollar is going to implode as we implode. Let me, I'm using some pretty, some pretty ridiculous words here. But we're going to come off, and we're going to continue to sell off, which will just perpetuate this rally that we're seeing in commodities. Absolutely,
right? Yeah. But I don't think.
So what do you think about the dollar here?
I don't dislike the dollar. I don't think you can be bearish in the sense of, the fundamentals are saying, that we want to be outright bearish, because I think maybe that comes later in the year as we start to price in and really start to trade the midterms. If the Republicans are going to get both chambers of Congress, that's a massive dollar negative story in itself, because you're going to have Joe Biden in the White House, and he's not going to be able to pass any agendas because the Republicans will both block everything, and that will happen until we get the next election. So that in itself is a dollar negative. When do you start expressing that there? And when we all know that the polls are suggesting that the Republicans are going to get both houses, so we know it's a theme that's going to happen, but the question is when do you start expressing that through dollar shorts? Apart from that, the US fundamentals are quite good. We're pricing a lot of rate hikes. It's just that everywhere else is doing exactly the same, right? We're pricing in 43 rate hikes in Europe this year alone. We've got 4 rate hikes in Australia and New Zealand. We've got 7 rate hikes being priced in. So it's, everyone's saying, why is the dollar not rallying? Because the Fed are going to raise rates. We're going to go QT in July. Well, everywhere else is doing exactly the same. The markets, and that's why we're looking at relative yield differentials in 2 and 5 year treasuries. And what we saw with in Germany, for example, is the discount that German 5-year treasuries and 2-year treasuries wear to US treasuries has closed. And that means when you're looking at capital, where you want to deploy capital as an investment destination, Europe's just become relatively more compelling, and that's why I think euro shorts have covered. So I think the idea is that the US fundamentals are okay. There's no reason to be outright bearish on the US on the back of that, but everywhere else has looked better, and I think that's where it is. So I think if we get a CPI number tonight, look, we'll talk about euro dollar in a minute, but if you get a break of 114.84, bang 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 bang, euro dollar's going up and it's going to start trending right now. So I think that's an interesting.
We'll see
one.
117 and catch a lot of people chasing, right?
Absolutely. Look, I want to go to some of those charts. So let's crack on with it's a setup, and let's have a look at the technicals here. Well, I'm still very much in awe of Blake's hair. I've got to bring on a chart of euro dollar. So lads, if we can just bring up a chart of euro dollar. Now we've got that double top in place, 114.84. Now if we do get a weaker CPI number coming through, I think we go and challenge that one. We have a third time at knocking onto that ceiling. We break it, we close. What you do then is you put on the Bollinger Bands, you wait for the Bollinger Bands to start widening, you put a 5-day moving exponential moving average on it, and you just let it define up to the top. And that's what we want to do. We want to look for this bull trending scenario. And I think if we get a weaker number, and everyone says peak Fed hawkishness, peak long end rates, peak short end rates, and the worst has been seen now. We should see inflation gravitate a little bit lower. I think you get a topside break of 114.84, and I think that's going to have huge implications. You just talked right there, Blake, about this idea about a weaker US dollar then manifesting into another leg higher in commodity markets. This setup here is really important. You can see that 23.6% retracement on that downside. That's curbing any downside. So if we were to see a strong number, I think that would get challenged, and then maybe if that closes through there, we can see a move down to that number 1, which is around 113.50. But really for me, I'm just waiting for the market to feed me and say, Chris, go and buy me, go and push me into a position, and that happens when we get a daily close above 114.84. That top side there, that to me is one of the most important levels in FX trading right now. What are you thinking?
I couldn't agree with you more. And one of the levels that I would be targeting initially on a break above 115 is like the August lows. I believe they're about 116.65, 116.70, depends on what feed you're using. Yeah. Then we have 117, which is a low back in March. So those are all levels that I think can be very easily tested. And if you just start going AB equals CD type of move, that takes you back to 120. Yeah. I don't want to be an outright dollar bear. I agree with you as far as the macro backdrop as far as the dollar goes, but that doesn't mean momentum traders and momentum trades can't take us up to those levels where whether you're talking 116, 117, 120 in the coming weeks or months ahead. So I think it looks great.
Yeah, I think we're just waiting for clearly defined levels that need to break, and when they do break, that's going to just force my hand, I think. So a really good one to focus on there.
Okay, well, I'm going to take us over to one of, you were talking commodities, Chris, and I wanted to take you over to the cotton charts, and I called that's a Haynes BPT. Now,
I have no idea what does it actually mean, you're just talking a crazy
the Haynes brand is I believe, American. It's about all as American as you can get. We as Americans, we see commercials of these, underwear and t-shirts. Everybody's got these soft Hanes cotton tees. They're probably one of the bigger, makers of cotton wear, underwear, and t-shirts and whatnot. But anyway, the point is that I haven't seen really prices in whether you're talking about regular clothes, cotton clothes, anything really go up until recently. And the reason why that probably is because cotton is actually breaking out and seeing levels. Now there was a move higher.
And your wife buys all your clothes as well, Blake.
Yeah, that's true. Good point. But there was a move back in 2009, pre-financial crisis where cotton spiked up, and I'm not too sure the reason why. But if you can go back into the 70s, and 80s, we're above those levels. We're in really breakout territory here in cotton. Now, I do have to say we get to prices points where we are at 161% Fibonacci extension. RSI is divergent, and so looking at that cotton chart, and I pulled up your chart specifically, the Pepperstone chart. Break below 122, we might see a little pullback towards the 200-day moving average, but I think you got to use those as opportunities to get long again. So, what do you think about cotton here?
Yeah, I agree. I mean, this is a ripping trend. I mean, there's so much capital going through. I mean, it does feel mature, and that divergence it has to be front and center. But for me, that's a beautiful trend. I'll be buying pullbacks. But for me, I would be looking at coffee. I think coffee looks great. I'd be buying that one. Soybeans, soy meal. I think that's if you want a bit exotic, and we ooze exotic, don't we, Blake? So I think they're ones that you need to put on there. So coffee, oats, and soy meal for me probably look a bit better than this, which is very, very mature at the moment. And let's go and have a look at the Nasdaq 100, because we've been talking about this. You've got that beautiful swing that we're seeing around 15,250. We've got the yellow circle around that. It really needs to break there. In fact, just between that red sort of rectangle box that we've got a combination of that swing high and also the 15,500 horizontal resistance that are coming in there as well. So we're sort of just testing the 200-day moving average. I know we're going to be focused on what's happening in the S&P. S&P held the 200-day moving average. It had an outside day yesterday, an engulfing that came through, and we've seen follow-through buying there as well. Now we're testing those 2nd of February highs that you talked about as well. So we need more work to do. But if we have a look at the Nasdaq, we see a little bit more flow in the Nasdaq. People like that sort of higher beta move, the higher percentage change that there. And when you catch one, you're going to get a higher percentage move. So people love this as a trading vehicle. But I think if we were to get a little bit more buying, shit gets real into that sort of red or pink rectangle box representing that recent high swing, and also the horizontal resistance level. So I'm going to be interested to see how price reacts into there, see the behaviours of the market, the sort of flow we see. If it breaks through those levels, then we see new all-time highs. I would have really strong conviction that we go on to new time highs. But into that red box, I think that's the supply zone that we need to be watching. What do you think?
I think my next chart is going to matter even more, but we're not going to go into that just yet. Yeah. But I'm with you as far as the Nasdaq goes. It's got some catch up to do, and I think there's reasons why the Nasdaq is kind of struggling, and one of them has to do with US Treasuries, and which we'll talk about just next. Yeah. But if the S&P starts to break higher, you look at the Dow. The Dow's breaking higher. You even look at you take the UK, you got the FTSE that's actually ripping right now. Yeah. I mean, you got a lot of markets that are pushing higher. The Nasdaq will get dragged higher by its pigtails at some point, and that supply zone, as you point out, is going to matter.
Well, it's difficult, isn't it? I mean, there's no traction in this market. I mean, it's been difficult to buy, and the S&P has outperformed. But I think in the moment, you're starting to see tech find its day in the sun. Whether it can continue, I think people have got low confidence in. So I think that's an interesting one. You brought up the good point there about what's happening in US Treasuries. So maybe that's a good place to focus on.
Well, let's turn it to Treasuries, and I'll tell you, going back to the Nasdaq really quick. The day that I get to use the restroom in the metaverse, this is gonna be like the best day of my life. I'm gonna try that.
All right. If you're into, mate, fair enough.
Anyway, total joke. Anyway, let's look at the 10-year Treasuries. Now, if you look at this chart, Chris, I'm going back to pre-2018. You take the 2018 lows that you can see there, it's at the bottom of the chart, to the 2020 highs. We're at the key, or close to the key 618 Fibonacci ratio, which comes in right around 126 or so. Now, that is a huge level for the bond market. It's a big fib level of multi-year chart, and everybody, even a friend of mine that he trades, but he's in commercial real estate. He texts me today. He's like, we're almost at 2%, because everybody's looking at 2% in the 10-year. We get above that. One of my colleagues have been talking about that literally for 12 months. He's like, if we ever get above 2% in the 10-year, well, that's going to equate to that 618 retracement basically in the 10-year futures. So when you're looking at that chart and you know we're at a key level support, we got some divergence. And if you think about it, if we bounce there, that means yields are going to come down, and that would really spur a move in the Nasdaq. So that's something that I'm looking at. What do you think about the 10-year here?
Well, if you have a look at the bond auction last night, the US Treasury got away a 10. I can't remember the exact the quantity, but it was in the 10-year duration. And I mean, the bids and offers were the bid to cover ratio was super high. So there was huge demand for treasuries or 10-year treasuries last night from the private sector, and that tells you that we've got yields getting into 2%, and people are happy to buy them and fund the Treasury Department as a result of that. So that's very bullish indeed. Yeah, we get a weak number in the CPI number. I think the front end of the curve comes down, a little bit of pricing comes out, and you're going to see term premium react, and I think you're going to see the 10-year come down. And yeah, that's going to be absolutely. It's going to have big implications for the dollar. It's going to have big implications for gold, and also for tech as well. So I'll be watching that. You can trade the 10-year on as an ETF with Pepperstone as well. So yeah, have a look at our range of ETFs. The IEF is the one that you want to be looking at there.
I wish I could do that. I got to trade futures. I wish I was trading with you guys out of the United States.
There you go, mate. But yeah, so I think that's an interesting. Yeah, absolutely. Watch the Treasury Department, Treasury complex. You talk about the moves there. I think that there's going to be some value in these markets now. But let's go to play of the day and let's see what's on Blake and my mind in terms of the plays there. Well, Blake, I'm going for Aussie CAD this week. So if we can bring up the chart there on the daily that we've got. And what I like is the idea that if you have a look at as a basic momentum strategy, it needs work, but I want to catch the vibe early. Now, I might be wrong, and if it clicks back below the sort of the horizontal grey line, I want to get out of the trade pretty quickly. But as a momentum strategy, you will end up having lots of small losing positions. But when you catch one big, and so your win-loss ratio will be quite low, but you might have when you get those risk-reward trades going through, what you're risking is a fraction of what you're potentially going to reward. Now, what I'm seeing here is this is broken out. We've got an inverse head and shoulders pattern just at the bottom there. You'll be able to see that. We've broken through the neckline, but we've also broken those horizontal resistance. And what we want to do now is ease into long positions. I want to see those Bollinger Bands start to widen. I want to see price hug that upper Bollinger Band, and I want to see the 5-day exponential moving average, which is a yellow line there, which has started to move up, contain any kind of pullbacks. And what I want to see, if price closes below that 5-day exponential moving average, I'm out of the position, but I want to see that define that, and I want to let this one ride. It's starting to show with all the momentum oscillators that it's working quite well. If this goes, I'm in the position, and I want it to just hug those widening Bollinger Bands. So I quite like the shape of what I'm seeing here.
All right, well, I'm going to keep with the theme of the Canadian, because actually this is like my proxy to sell a little crude, because I'm too scared to sell crude up here, but I think it is easing off of these 90s, and I think it's going to trade back into the 80s. But the way I want to express that is being long the euro versus the Canadian. I do want to buy a dip though. All right, so there's two ways to trade this setup, in my opinion. It's boom above the 200-day moving average. That means we're going to breach that. You can see all that previous support way back in like the spring of 2021. Also that high back in December of 2021. We break above that, break above the 200-day moving average. That's just a straight up breakout. But what I'm trying to do is I'm trying to piece my position in, get a little bit of a taste of it down at the 50% retracement, about the 143.75, 144 level. Any dip down to that level, I'm looking to trade it, because remember, the Euro Canadian had a false breakdown, just like the Euro dollar did. So when you can trade that to the upside, when you have a false breakdown, leads to a breakout, I'm going to play it the same way, just with the Canadian.
Great stuff. Well, thanks, Blake. And it's sort of mentioned as well, it might be the Super Bowl in America, but in your state, there's the biggest game with your son in the playoffs of his soccer finals as well. So I wish the Morrow family the best of luck there. I'm sure it's going to be a proud dad moment for you. So obviously I hope he keeps a clean sheet in gold. So that's great to see. Apart from that, obviously, keep an eye firmly on what's going on in US CPI. Could have big implications on what's happened in the dollar rates, gold, and of course equity markets. And we've talked about anything and everything that's going on in front of centre. Blake's looking at EUROCAD on a pullback. I'm looking at Aussie CAD, and we've gone through some of the other programs there. So if you like what you hear, obviously smash the like button. It'd be great to see. And we'll see you again next week for more of the trade-off.